Welcome back to Resonance Spotlight Strategy Notes. I'm Vincent.
And I'm Saâd. And today we're going deep on something that I think is honestly one of the most underappreciated shifts happening right now in institutional investing.
Yes, we are talking about the Total Portfolio Approach, TPA. And before people switch off thinking, okay, this sounds like something only a pension fund with 50 billion care about, I want to say, stay with us. Because the thinking here is relevant for anyone who is seriously managing a portfolio.
Exactly. The concepts transfer even if you are running a family office, a smaller endowment, or you are advising clients. The mental model here is very useful.
All right, let's get into it.
So, Vincent, let's start with the problem, because you can't really appreciate why people are moving to TPA unless you understand what stopped working.
And the simple answer is the year 2022 broke a lot of assumptions. The classic 60-40 portfolio, 60% equities, 40% bonds, that was the default for decades. And it works because bonds and equities move in opposite direction. When stocks went down, bonds went up. You had this natural cushion.
And then in 2022, they both went down at the same time.
Exactly. Both asset classes sold off together. And for a lot of institutional investors, that was a real shock. Because the diversification they thought they had, it wasn't really there when they needed it.
The correlation between equities and bonds shifted. The negative correlation that everyone was relying on, it broke down. And this is not just a temporary thing. It reflects something more structural. When inflation is the dominant risk, equities and bonds become correlated. They suffer together.
So the old model, set your allocation, rebalance periodically, collect your diversification benefit, that becomes unreliable. And that is precisely the context in which TPA starts to make a lot of sense.
Okay, so let's define it. What is the total portfolio approach?
I like this description. It's become a state of mind more than a fixed formula. And I think that's actually a good way to put it. The core idea is you stop thinking of your portfolio as a collection of separable buckets, equity, bonds, alternatives, real estate, and you start managing everything as one unified whole.
And the question you're always asking is, does this asset, this position, does it improve the total portfolio? Not just, is this a good equity pick or is this a good bond? But does this make the whole thing better?
Every asset has to earn its place. That's the phrase I keep coming back to. Every single position must justify itself by what it contributes to the total risk-return profile.
And that sounds simple, but the implications are quite profound, because it means you're not managing separate risk budgets for each asset class. You have one risk budget for the entire fund.
And you're measuring success against the total fund objective, not against some individual sub-benchmark for each sleeve, which is a completely different way of thinking.
Right. In traditional SAA, you might have an equity team that's judged on how they perform versus the MSCI world. A fixed income team judged against a bond index. They optimize their piece of the pie. But that can lead to situations where each piece looks fine in isolation and the total portfolio is actually exposed to the same risk from multiple directions.
Which is exactly what happened in 2022. You look diversified, you went.
Let's go a bit deeper on the comparison, because there's a concrete data point I want to highlight here. When you look at sovereign wealth funds that use TPA, some that still use traditional SAA, you can see the difference in behavior quite clearly.
Yes, Australia's Future Fund is a great example. They moved to TPA early, and when COVID hit in 2020, they shifted allocations meaningfully and quickly. Whereas CalPERS, which is a massive US pension fund using traditional SAA, largely stay close to its fixed weight.
And the TPA funds over time have delivered higher risk-adjusted returns, One study puts the advantage at roughly 1% per annum, which over decades of compounding is enormous.
Now, 1% doesn't sound like much, but on a fund with billion under management and over 20 or 30-year horizon, it's transformational.
So what else is different beyond the returns?
Well, a few things stand out for me. First is the factor lens. Instead of thinking in asset class labels, equities, bonds, TPR thinkers ask, what are the underlying risk factors? Is this exposure giving me growth risk, inflation risk, liquidity risk? You disaggregate.
And that's how you avoid the illusion of diversification. You might hold 10 different asset classes, but if they're all loaded on the same growth factor, you're not actually diversifying.
Exactly. The CPP, Canada Pension Plan, is a good example here. They move away from traditional benchmarks entirely. They evaluate everything in terms of risk and return contribution to the total fund. The head of total fund management said something like, with SAA, you are thinking in asset space. With TPA, you're thinking in risk-return space. And that gives you much more control.
And the second big difference is just the agility. TPA funds are not constrained to rebalance back to some fixed target. They can and do make much larger shifts when conditions warrant it.
In a traditional SAA setup, tactical overlay might give you a 5% tilt maybe. In TPA, if you see a regime shift, you can move with much more conviction.
Okay, so we've established why TPA is better in theory. But how do you actually do it? Because I think this is where it gets hard.
It does. And the honest answer is the successful adopters invested heavily before they ever saw the benefit. New Zealand Super Fund, CPP, the Future Fund, they all spent years building the governance, the analytics, the culture.
Let's take governance first, because I think this is the piece people underestimate.
In a traditional setup, the board approves the policy allocation, 60% equity, 40% bond. And then the investment team executes. With TPA, you need the board to delegate much more discretion to the investment team. The board's job shifts from approving weight to monitoring total portfolio outcomes and risk.
And that can be politically sensitive. Boards and committees that are used to fixed benchmarks can feel uncomfortable when you move away from them. It's harder to explain to stakeholders.
Which is why communication is actually a core implementation challenge. You need to be able to explain, here is our objective, here is our risk budget, here is how every decision we make relates to that, without the comfort blanket of 60-40.
And then there's the analytical side. TPA requires much more sophisticated systems. You need to aggregate exposures across the whole portfolio. You need scenario analysis tools. You need to be able to model. If we shift capital from here to there, what happens to our total volatility, our drawdown exposure, our liquidity profile?
This is not Excel. This requires real investment in risk infrastructure.
And then maybe the hardest part in the team structure. Most investment organizations are signed up by asset class. You have your equity team, your fixed income team, your alternatives team. TPA requires these teams to collaborate in a completely different way. Everyone is accountable to total portfolio outcomes, not just their suite.
Which means you may need to rethink compensation, reporting lines, how you attribute performance. All of that has to align with the total portfolio objective, not individual asset class benchmarks.
All right, practical question. For someone listening to this, maybe they run a family office or they are a CIO at an endowment, where do you actually start? Because you can't just flip a switch.
No. And I think the key insight here is you don't have to abandon your SAA overnight. The approach that makes sense for most people is start with a reference portfolio, a simple policy benchmark, maybe 60-40, maybe 70-30. This becomes your baseline.
And then you treat all active decisions as deviations from that reference. You're constantly asking, does this deviation improve the total portfolio versus just only the reference? That discipline alone gets you a lot of the TPA benefit.
Another practical step is a shadow portfolio. You keep running your current SAA, but in parallel, you have a team or committee that asks, what will TPA look like right now? What will we do differently? You track that portfolio. You track that shadow portfolio. Over time, if it consistently outperforms, you build the credibility to actually implement those changes.
And widen your opportunity set. TPA can't add value if you're restricted to 2 or 3 asset classes. You need to be able to access alternatives, private markets, systematic strategies, things like trend following CTAs, insurance linked securities. These are the true diversifiers that a TPA approach would include.
Broad opportunity set, unified risk budget, decisions measured against total portfolio impact. That's the core.
And crucially, upgrade your liquidity management. When you move into more alternatives, more illiquid assets, you need a rigorous liquidity budget. You need to stress test what happens if markets dislocate and we need cash. Where does it come from? You can never assume the total portfolio is liquid just because parts of it are. Okay, before we wrap up, I want to be honest about something, because I think we've been making TPA sound almost too good. And I don't think that's fair.
No, I agree. Let's do this. What are the real criticisms?
I repeat, criticisms.
I repeat, what are the real criticisms?
The first one is about scale. TPA works beautifully at NV Super or CPP because they have dedicated quant teams, custom risk systems, governance structures they've been building for 20 years. For a smaller institution, a family office, a mid-sized endowment, the infrastructure alone is expensive. And if the return advantage is roughly 1% per year, you have to ask, does the cost of building all this actually justify the benefit?
That's a fair point. And there's a related issue with the performance data itself. The institutions we keep citing, Future Fund, ND Supra, CPP, these are exceptional organizations by any measure. Long mandates, talented teams, very low political interference. It's genuinely hard to know if the extra returns is coming from TPA or just from having better people and better governance in general. The data is a little...
Exactly. We don't hear much about the institutions that try TPA and struggled, because they exist.
And this connects to the behavioral argument. One thing I actually respect about traditional SAA is the discipline it enforces. You set your allocation, you rebalance mechanically back to target. It removes the temptation to react to short-term noise. With TPA, you have all this flexibility. But flexibility in the hands of a team that isn't disciplined enough can just make making bigger mistakes with more conviction. I repeat, but flexibility in the hands of a team that isn't disciplined enough can just mean making bigger mistakes with more conviction.
The rigidity of SAA is a feature, not only a bug. I think that gets forgotten sometimes in these conversations.
There's also a governance paradox that I find interesting. TPA promises agility, the ability to move quickly while regimes shift. But in reality, making large allocation changes require committee approval, cross-functional sign-offs, board oversight. In a fast-moving crisis, that process can actually be slower than a simple rebalancing rule firing automatically.
The agility exists on paper. Whether it survives contact with the real institution decision-making process, that is a different question.
And then there's what I call the concentration of authority problem. Traditional SAA distributes decision-making across asset class teams, equity team, fixed income team, alternatives team. If the equity teams makes a bad call, the damage is contained to the sleeve. With TPA, you're centralized. One unified risk budget. One CIO with full discretion over the whole thing. If that person has a bad macro read, there's no silo to absorb the impact. The whole portfolio suffers together.
That's the single point of failure problem. And it's real. There's also the liquidity issue. And this one I think is underappreciated. TPA naturally leads you toward a broader opportunity set, more alternatives, more private markets, more illiquid strategies. That's fine when you're building the portfolio, but over time, you can drift into a position where the portfolio looks diversified, but is actually quite illiquid. And you only discover that when there is a drawdown and you need cash.
Illiquidity creep, and that's a good way to put it. You don't feel it happening gradually, and then suddenly the very flexibility TPA is supposed to give you, the ability to rotate and reposition, is gone. Because half the portfolio is locked up in 10-year private equity.
The last criticism I'd raise is accountability. A 60-40 portfolio is easy to explain to a board, to beneficiaries, to family principals. We hold 60% equities, 40% bonds. Everyone understands that. TPA is genuinely harder to communicate. When you move from 45% equity exposure to 30% based on a regime model and a factor signal, explaining that to a trustee who is not a professional investor is not trivial. And when it underperforms in the short term, because it will sometimes, the pressure to abandon the approach can be intense.
So to stillman the critics, TPA is potentially more powerful, but it is also potentially more fragile. It asks more of the people and institutions using it, and most institutions are not CPP investment.
Right. Which is why the phased approach we talked about earlier is not just a nice to have. It's genuinely the safer path. Build the capabilities before you build the exposure. Don't adopt the philosophy and the complexity at the same time.
Okay, Saâd, let's bring it home. What are the key things you want people to walk away with?
3 things for me. 1, the old assumptions are broken. The 60-40 negative correlation between equities and bonds is not reliable anymore. You cannot build a portfolio and assume that structure will protect you. That part of the TPA argument is solid.
2, TPA is not about abandoning strategy. It's about making your strategy dynamic. You still have a reference point, a long-term objective, but you're continuously asking, is it still the best way to get there? And you're not afraid to change direction when it's not.
3, be honest about your own institution. TPA is more powerful, but also more demanding. It requires better governance, better analytics, better culture. If you don't have those things yet, jumping straight to full TPA discretion can make things worse, not better. Build the capabilities first. The shadow portfolio approach, the wider rebalancing bands, the reference portfolio framework, these are real steps, not just compromises.
The payoff is real when the conditions are right. The data from sovereign funds that have done this well is compelling, but the key word is done this well. TPA in capable hands with the right infrastructure delivers better risk-adjusted returns. TPA in the wrong hands without proper governance or liquidity discipline can amplify mistakes. It's a high-performance tool, not a magic formula.
And then in markets like this, where regimes shift faster, where correlations are less predictable, that agility is increasingly valuable. If you're rethinking how your portfolio is structured, or if you're debating governance versus flexibility, we'd love to hear your perspective.
And if you have a topic you would like us to dig into, a question about regime allocation, factor exposure, portfolio construction, send it our way. We read everything.
Until next time.
Take care.